Nice to see you.
Good afternoon, Canada. Hope all is well.
It is all well, and I was surprised actually, to see your notes to me today that you have a little bit more concern about the uncertain times, the riots, and therefore perhaps even the need to go long gold. What are you thinking these days?
Well, thanks for bringing up both of those. Let's talk about gold first. I mean, clearly when you have an asset outperform the TSX since the February 20th high by almost 45%, you have to obviously take aware of that. But, you know, from a longer term structural and secular basis, gold companies in Canada have done a wonderful job rebuilding their balance sheets, restoring cash flow, paying dividends. And I think that has, quote unquote, really helped them. So too has the worst pandemic in 200 years, record low risk-free rates, record low interest rates, record high risk premium. So clearly gold's been on a tear, and we are officially neutral gold, especially given the fact that gold now is making up 12% of the TSX. It's at or near historic highs with respect to its weighting. Also, too, that earnings revisions have almost never been better in terms of analysts revising their earnings higher. So we're not telling people to rush out and add to their gold positions, but we are saying maintain those positions. Plus, as you said in your preamble, you hear about people like Buffett buying gold, which, oh, by the way, already happened. So if you're buying gold today based on Buffett's recommendation, you're late. But I would say maintain those neutral positions in gold.
Why not be a little bit more aggressive than just neutral? And you do talk and make a good point, and there's been a lot of writings about this over the past couple of days, that the retail investors kind of chasing this gold trade. What do you say to that?
I would worry about that from the retail perspective because they're late, especially considering the type of move that we've had. Now, remember, too, even before February, Catherine, we had a big move on a historical basis with respect to gold. And if you take a look at other commodities like silver, wheat, and the like, we've had lumber per se, and of course, paper with respect to what we've seen in terms of packages and things like that, container board. I mean, we've had a big move in the commodity structure, whereas emerging markets, which typically is more tied to the commodity area, especially the CRB index, has not really moved step in step. So from a fundamental perspective, the commodity structure could be a little bit ahead of itself, but I don't think it's a sell here, Catherine. I just think it's something you don't want to chase, especially after it's gone up so much.
And what about silver, though, Brian? You and I don't normally talk about the precious metals, but there's been a lot more focus on silver, just given the fact that perhaps it hasn't been as of interest to so many investors. Where do you stand right now?
It's the same. I think from a longer term perspective, especially the type of price appreciation, silver's done even better. And you know, from a near term basis, we've seen a little bit of a spike as a catch up. So we would maintain kind of a more of a neutral stance there. And the material sector in Canada, from a sectoral basis, overall has done very well. Aside from the papers and the FERTs and things like that have participated. So from a silver perspective, we still see demand there. And longer term, it's a commodity I think is very important, but it's playing the catch-up trade right now that we've seen in gold.
And Brian, let's shift focus here a little bit and talk about a segment of the market that, again, you and I don't talk often about, which is taking a look at some of the security names. Just given the social unrest, I think that's your thesis here.
It is. And, you know, listen, I think as an investor, you have to kind of think about themes, not just earnings or valuation. You want to think kind of big picture. And that's why we've been so positive on the mobile society. And we wrote a piece entitled From FOMO to FOGO. And now we're looking at security, from personal security to what's happened in the police force in terms of talks of defunding the police and law enforcement changes here, and just how that has happened in the United States and what it looks like going forward. So companies from ADT to Brinks to Google and Apple, I think the key to the security space isn't too much difference, Catherine, relative to healthcare and some other areas, meaning it's going to be heavily technology laden in terms of body cams and things like that. I think it's a real trend that I think is still early on. So investors should be in mind that this is going to be an area that's going to grow a tremendous market share in terms of personal home security, could double in the next few years.
So, Brian, let's just go through a few of those names real brief. ADT is one that you're looking at or maybe already have in the portfolio?
We don't own in the portfolio, but it's a name that fits that in terms of just home security. Brinks as well in terms of just, everyone has seen Brinks armored cars and things like that, but Brinks also has a division in terms of personalized security. I think in the portfolio, if you take a look at names like Google and Comcast and Apple, just because of what they're doing on the video side with respect to home security, are names that we've owned, of course, for other reasons, but also fit through with that security theme.
Just to pick up on Apple for one moment, approaching $2 trillion in market cap. What do you do with the name right now? How do you manage that within your portfolio?
It's a great question. We maintain our positions there, and we've been long-term holders of Apple, as you know. I mean, the stock now is a little over 6% of the S&P. It's a very difficult stock to be overweight, and most growth managers typically cannot be overweight Apple, Catherine, and that's why you and I have talked through the years that Apple has been used as a redemption tool for many growth investors, and I think that's why they've been underweight Apple, quite frankly, so dramatically. And as Apple's been hitting new highs, it's really hurt the portfolio if you don't have enough of a position. So we've maintained our core positions there across the majority of the portfolios that we run for BMO. So we still like the stock longer term, and we're looking forward to see what happens this fall with the new product line.
Okay. Brian, outside of some of the security ideas that you're giving us and also gold, I should get from you your gold pick.
Well, we like Agnico. We've owned that for a long time. In our report that we published on Friday, we actually listed 29 outperform rated names from our great analysts at BMO. So if anyone that's a client, they can see those names. But we've owned Agnico for a while. The stock is run. People that have heard me talk for years, we don't like to sell stocks unless something fundamentally has changed with the company. Just because the company has gone up a lot, or the valuation has gone up, doesn't mean you want to sell it. We're going to maintain our position there, and we still own it, and we've owned it for a long time.
Okay. And just curious, Brian, do you own, or have you ever owned Berkshire Hathaway shares? I mean, maybe Class B, not A. So
I do.
Do you think of that?
No,
idea?
not A.
Do you?
Well, yes, I've owned it for several years, in fact, and it's been a name that we've actually maintained our positions. And, the performance of the Buffett's funds have actually not been on par relative to his recent past. And so the one thing that I would caution investors by just buying something because Warren Buffett's buying it is that, frankly, I think his involvement with the fund is not what it has been recently, number one. Number two, I'm a little fearful, again, that he may be chasing performance here a little bit. Number three, remember, too, that he is a true value investor. And if you're buying gold for value, it's not a value kind of pick, especially with respect to where book values are and cash flow are or enterprise value. So I'd be a little bit leery of that in general. But we've owned Berkshire Hathaway, Class B, for several years.
Mm-hmm. Don't you think, though, that the company as a whole, the holding company, the conglomerate that it is, has so many businesses really that aren't publicly traded companies? You don't have to almost worry about where the market goes. They've got beautiful cash flows on their own.
They really do, and they own companies like Dairy Queen. I mean, what's better than Dairy Queen? But people think about financials right away, but I think of Dilly Bar. So I mean, again, from the time tested in terms of the dividends and how they manage their cash flow, I think it's a story from a longer term perspective, as we in the marketplace, Catherine, quite frankly, still kind of tug of war with respect to growth or value. When growth is scarce, growth outperforms. But a stock like Berkshire Class B kind of fits and checks those boxes because it has a mixture of both growth and value stocks.
Fair point. All right, Brian, great to see you. Happy Monday.